Today we are going to discuss one of the most mismanaged parts of retirement planning, and that is actually managing your risk, entering retirement, and how to set up your portfolio so that you are successful before and after retirement.
Hey Tony, how we doing today?
Yeah, buddy, we're doing well.
Awesome.
We are doing well. Just feeling good, man. Positive. We're going to talk about some retirement planning.
Absolutely.
We're going to talk about the pre and post retirement planning, and it's more about, we're going to talk a little bit more about the portfolio setup, right? What got you there, and can you get off of the kicking and screaming train saying, I don't want to change, because change isn't fun. Right. What may have got you to this point to retire may not be the best situation when you do retire. Right. So let's talk about that a little bit. Managing risk, heading into retirement. We have maybe even mentioned this on a past show or two, but when we build a financial plan, one of the what ifs. What if this happens? What if that happens? What if I buy a house? What if I retire early? What if I what ifs, yeah. Right? What if the day you retire we enter a bear market? We really make it extremely aggressive. It's like, hey, I'm working on Monday, I retire on Tuesday, and the market goes down 20% on Wednesday.
Right.
We know that can't. Don't want to say it can't happen, but like, what if, right? What if we have an extreme market, your retirement assets are wiped out by 20%, and you have to quote unquote build back.
Right.
That is the worst time for the market to go down, is when you retire. And I mean, honestly, I would say that the way the market's been the last 3 years, 4 years, 3 years. Yeah. The last 3 years have been double digit, high teen type of returns. And it probably has thrusted so many people into retirement because their accounts have just grown so much in the last several years that they have the I can make it attitude. And the plans in our financial plans for clients support it, right? Because when we build a plan at 6% rates of return and you do 14, guess what? Your plan's better. When I hit the refresh button. So we're always conservative on longevity. We're conservative on rates of return, so that we can pivot and be prepared for downturns. And no one's seen a downturn in a long time. So when the market is down 2%, people start freaking out.
Yep. That's the first thing I wanted to mention.
Yeah. So we're going to talk about managing risk, entering retirement and post-retirement, and why time and not returns is your biggest risk in retirement. Because once you're done working, you're done saving, you're done earning, and you're now spending. And the last thing you want to do, investing 101, the worst time to pull money out of your portfolio is when the market's down.
Yep, for sure.
You're going to sell something at a loss. You're going to lock in the loss to generate income. So we need to talk about all kinds of things in this episode to help structure and hopefully visualize how the portfolios are set up. So why don't you kick us off, Dave?
Yeah, I think that one of the easiest ways to say it is, when you're approaching retirement, you want as little, and when you're obviously in retirement, you want to leave as little to chance as possible. So, a few weeks ago now, Tone, when you were out, Jack and I, we talked about debt, right? And how accumulating debt, especially like credit card debt, right around retirement, is going to have a negative impact and potentially make your retirement plan not work. The same thing applies here with structuring your portfolio as you get closer to retirement or you're in retirement. And the thing that I kind of want to touch on, since I've heard some questions on it lately, you want to avoid making huge changes to your overall structure in your investment portfolio. That's called market timing. And I'm going to say the same thing. No matter what topic that we're talking about, if you try to time the market, regardless if it's good times, regardless if it's bad times, you have to be correct twice to make it work. So let's say we'll start with the events around what's going on today in the stock market with all the conflict going on in the Middle East. That's going to cause volatility, right? If we panic and we pull all of our money out of the stock market when it's down 10%, we might miss some downside. But when are we getting back in? So we don't miss any upside.
I'm not challenging that, but I'm gonna try and back this up. But
Okay.
saying like you're right, like and I'm not gonna call it market timing, but like let's use an example of I'm going to use like the company stock people.
Okay.
Right. And I'm not trying to say anything bad or anything, but like, some people that I have met and working with, have done extraordinarily well because they put all of their money in their company stock in their 401k and became millionaires, multimillionaires, Progressive, Sherwin, Parker, you name it. Right.
Right.
And I said it before. It's kind of like what got you here may not get you there.
Right.
Right. And it's hard to tell somebody, be like, man, you won the game. Like please, can we tone down the risk?
Right.
Because you're 100% in this one stock, and one bad quarter, quarterly, one bad quarterly, return or conference call or whatever, man, like earnings call, like you could be down 10 to 20% because it's a singular stock, right? And again, it's kind of like that's why we build the plan. Be like, we can tone down the risk, but I also don't. I also like where you were going with that, and my mind goes to dollar cost averaging. I do this in quite a few things. So like Roth conversions. Mm-hmm. Hey, I want to convert $30,000 this year. Do I do it all today, or do I do it at the end of the year? Do I try and time the market? Right. So I dollar cost average into that. I'll do half in the summer and I'll do the half in the fall. Right. I'll do 15 grand in July and do 15 grand in December.
Right.
And just space out the risk for ups and downs, because if I convert 30 grand today and the market goes down 10%, I overpaid in taxes, and I can't undo it. Right. So that's where I don't want to be. If the market grinds up, I'm like, okay, well, I was hedging. That's what happened last year. I did half in the beginning of the year and I did half at the back end, and the accounts still continue to grow.
Yep.
But that's just a risk measure, because what if it wouldn't have gone that way?
Yep.
Right. But that's the same thing with owning the company stock. Just because you're 100% allocated, you should probably step into more of a balanced portfolio heading into retirement or in retirement. So going from 100% equities, maybe the first step is to go 85-15.
Yep.
And then you try and ease your, in every quarter, you're just getting, if the goal is a 65-35 or 70-30, whatever your plan and how you want to see your money grow, or maybe not bounce all over the stock market. But also it's divesting from that in particular stock too.
Yep.
Because it's not just, hey, we're not going to continue to hopefully hold a lot of the company stock that got you there. I understand that there's a loyalty and you're comfortable with it. It made you a ton of money. I understand all that stuff. But I'm trying to manage risk, and I'd rather have a basket of stocks than just one singular. And I'm not trying to hone in on that. It's just, but that's the whole thought process of just that one particular type of client.
Yep.
Now we have other people like, hey, I've just been in SPY, I've been in the index, and right. And I'm like, well, what about, like the small caps and the mid caps and the international and, like the market can go down 20% in 3 weeks. And what do you do then? Like, do you have anything to grab onto that might have either be flat or down slightly, or maybe even up, like bonds, right? Like, I mean, what are we going to do? How are we going to prepare if, the market does turn over and your in retirement, and we're taking income from the portfolio. What do you do, right? So
yep. And this is a great example, and I think we just usually come in with the stuff that we see, right? So company stock is a big one. Concentration into quote unquote favorite stocks also an issue. I've seen from time to time. I always go back to a person I met long time ago now. Every single dollar that they had was in AT&T. I don't know why they didn't work there. It was just the stock that they picked. Yep. So I mean, at the time, $900,000 all in AT&T stock. He said he was quote unquote comfortable with it, but it is such a massive risk to have such a concentrated position like that. Another risk that I've seen lately is just people's kind of stock allocation percentage has just kind of creeped up over the last 2 or 3 years. Market was down a good chunk in 2022. If you were 85% in stocks at that point and you didn't really do much rebalancing, you're probably over 90% now in stocks. So not only rebalancing, but kind of having a strategy on maybe lowering the percentage a little bit when tensions get high, maybe increasing that when times are when the market's more poised for upside. These are things that we're kind of doing at a higher level when we're managing money. We're not making big bets in and out of the market. We're trying to gradually build on what we're believing in.
Right, and I'm glad you brought that up as well, because think about this. We've had 3 consecutive years of like double-digit returns. Yep. Right. Going into the 4th year, like it's uncharted territory. Like it's never really happened before. And I know our investment team, they trimmed positions at the end of last year because we don't want to get quote unquote round tripped.
Right.
I buy a stock at 100, it's now 200. I'm flying high, and then I wait, and now it's worth 120.
Right.
Like, oh, well, I'm only up 20 and not 100.
Exactly.
Now everyone's angry, right? My guys, I don't want to call them emotionalists, but they are. They're bringing in a non-emotional attachment to the stocks that we own for our clients, and we took profits. And and then I got a couple of calls like, "Hey, man, my tax bill's a little higher," and I'm like, "Yeah, I mean, I know, and no one likes paying taxes, but at the end of the day, paying taxes is a penalty of success. It means you made money.
Yep.
If you're not paying taxes, we got other issues, right? It could possibly.
Yeah.
But the thing is the whole rebalance thing is extremely important, and because we want to have a broadened out, we want to stick to the plan. How was the plan designed? Was it a 70-30 and now you're 80-20? You got to take those chips off the table, because that's how the plan was designed, on a risk basis. I know your account's up. We could be wrong selling equities at this time. We could be right, but it's a system, and over a long period of time, systematic, changes to the portfolio win over the emotional side.
Absolutely.
So.
And another thing I've seen is people freak out and get away from that system, whether things are going well or things are not going well, right? People see an asset class on TV going sky high, they want in on that, right? Sometimes they want to chase it down. There's panic in the market, people want to sell, right? Those are just the natural the natural human emotions. So
well, and also, take the emotion side is like, man, don't watch shiny objects.
Right. Crypto,
leverage ETFs. I've been getting a lot of questions like, Tony, how can I get involved in SpaceX? And I'm like, you can't, unfortunately, right? It's going to IPO, and the people that are privy to that are, the owners, the board members, the high executives, maybe some of the employees, things like that, right? I mean, when it IPOs and you see it's up 300%, how did I get in on that? Because you can't.
Right.
Right? Now you get to buy it from the people that just made a bunch of money, and good luck, man. It's highly volatile afterwards, right?
Yep.
It could be a big win. I think that's going to be an interesting stock to watch because it's going to be so hyped.
Yep, for sure.
But that's an example, right? And like, when do you want to get in? Do you want to like get in day one, or do you want to wait like a couple days or a week or something and just see how it plays out? And that's the recommendation I gave to the one client. I'm like, hey, we're not going to over allocate anyway. And like, let's see how it plays out, man. And then the other thing is that we talked about rebalancing, but also, again, just chasing the shiny objects. We have to be careful. We have to limit our exposure to that stuff. Yes, they can be home runs, but man, they can be complete strikeouts and whiffs.
Yep.
So with that being said, building a portfolio when we definitely starting income in retirement is such a big deal. I know a lot of people they want to be invested all in equities, but we have to be careful. And that's why I'll go back to a simple theory that we did when we were teaching educational classes, the 3 bucket system, short-term, midterm, and long-term investments, right?
Yep.
The short-term 0 to 5 years, the midterms, that 6 to 10 year time range. And then the long-term stuff is 10 plus. We can give it time to go up, down, left, and right and let it grow. Right. So visually creating a bucket system that generate the income we need in retirement is also a very important part of this too.
Yep, for sure. Yeah, I think the last thing that's piquing my interest here is, custom strategy over cookie cutter allocation. I think that is going to be the utmost of importance is kind of, asset selection. I'm not sure just riding the indexes over the next couple of years are going to be, a winning strategy. So being able to be nimble, be able to change on the fly, not just park all your cash in index funds. I think it's going to a custom strategy based on your plan and your situation is one of the most important things that you can do, especially as you get into retirement. So, make sure you're taking a look at that. And I've always I've talked about it many times. Been a proponent of taking some chips off the table when you win. So we're talking about rebalancing, but as things go well, especially for us and our clients over the last couple of years, hey, let's take some of those gains, take them off the table, let's make them safe, and kind of apply it to your income in retirement.
We're selling stuff, on the higher end. Let's go let our team do what they do best and go and find value elsewhere.
Right, exactly.
Because there's stuff that hasn't participated on the stuff that went up, right?
Yep.
So with that being said, this is one part of the whole planning process, but it's important. And it's like simply managing risk, rebalancing, not getting attached to shiny objects, and sticking to the plan. Right. So with that being said, let's wrap this up, D.
All right. Well, thanks for listening out there. If you guys have any questions, comments, ideas for our show, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.